Some selling in the US market after it came back from a long weekend. Nigel has more in the World View.
Well, overnight, the markets were in a bit of a flux because reports indicated, the Financial Times had reported that the United States had cancelled its meeting with Chinese officials. And on the back of that, those markets moved lower. But there was a bit of a recovery from the lows because Larry Kudlow, he said that, in fact, there was never a meeting that was planned. And that's why no meeting was really cancelled. That's what helped a bit of a recovery from the low point of the day. By the end of it, though, the Dow still ended with a cut of close to around 300 points approximately. A couple of stocks were dragging yesterday's trading session. Goldman Sachs as well as Caterpillar, both of them were a couple of big losers, while economic data as well didn't look very, very good because existing home sales, that came in lower by around 6.5% for the month of December, and that was much lower than the anticipated decline of around 1%. European markets as well, they were in fact under pressure yesterday. Global growth slowdowns, that's the big theme out there, and because of that we had all the three frontliners ending in the red. UBS came out with its set of numbers, missed estimates. That stock was down close to around 3% in yesterday's trading session. A quick check on the dollar index, that's more or less stable at around 96.3 odd, while the dollar yen, that's moved from around the 108.5 odd mark, moving towards the 110 odd mark. But Brent crude prices have cooled down. If there's going to be a slowdown globally, then Brent crude prices, we saw yesterday itself, it dipped below 62 odd and currently holding at around 61.5 odd. Most of those markets flattish. The Nikkei has recovered from the low point of the day. The Kospi is the big outperformer today. SGX Nifty suggests a bit of a green tick just to kickstart trade. Back to you guys.
Okay, a bit of a green tick is the operative phrase, right? 12 points in the green. Let's see which way it heads. But for now, here's a CNBC exclusive. Morgan Stanley's Ruchir Sharma believes that the US market has hit a peak and the market has been underestimating the Chinese slowdown concerns. Here's an excerpt of that conversation.
The American stock market has hit a peak. It's possible that this is a more long-term peak than is currently anticipated or currently sort of forecast by many people. So I think that one of the big themes we have playing for the year is that we are at peak America, that the American stock market is at a 100-year high relative to the rest of the world. And that sort of is about as stretched as I think that the American stock market is going to get. But the immediate concerns have to do with China. And I think that that is possibly being underestimated by the market, which is that there is this great faith that the policymakers in Beijing are about to come out with another stimulus, and they have been doing a series of easing measures. And those stimulus measures are once again going to rescue the Chinese economy. The US stock market now is a much more global stock market. Like about 1/3 of all the earnings and even more of the profits of late have come from overseas. So I think that to speak about the US stock market just as US is not something which I would do. And then there is the whole issue of valuations as well. The fact is that the US stock market has been doing really well because of the tax cuts and other sort of measures that have been taken here. But the US stock market on a valuation basis is also trading at close to a multi-decade high. I think the highest level in post-World War II history relative to the rest of the world. So it is about what's priced in where, and the least amount of disappointment is priced in here compared to what's happened internationally in places like Europe, where it's pretty obvious that the Chinese slowdown is hitting them. Talking about a complete recession out here in the US, but a major slowdown unfolding as the stimulus measures fade. But I also feel that the interlinkages are seriously underestimated compared to what they used to be. I mean, in late 2015, early 2016, when you did get a very serious global slowdown, it did impact the US much more until the Chinese were able to do a massive stimulus, and that helped global growth, including US growth. So I don't sort of agree with this very insular argument that the US is going to sort of remain completely protected by these great oceans and, it'll continue to sort of ride its own theme. I personally feel that the risks are really there. In China, all the reports from the ground suggest that a very serious slowdown is underway. And the more sort of worrying aspect is that there's really not that much that they can do out here because US interest rates and Chinese interest rates now have converged. And for them to cut interest rates further from here to stimulate the economy poses a very serious risk to the currency, and they don't want that to flare up as well. So it puts them in a much tighter spot than they have been in the 3 other instances this decade when they have rolled out a massive stimulus. Markets have now gone into pricing a lot of some sort of a trade agreement compared to expectations of virtually nothing happening in, let's say, October, November last year. So I think a lot of that now is getting priced in. But I think that this is, there's a more fundamental issue out here, which is that regardless of what happens on this trade front, we are in an era of deglobalization. The world is sort of getting much more split into regional blocks, and barriers are going up everywhere. And I don't see that changing with one US-China trade agreement.
Okay, that's the word coming in from Ruchir Sharma, where he says that there are no shock absorbers, so to speak, that could help shield the US or, for that matter, any other country from the Chinese slowdown that's currently underway. Well, that's the macro theme, but we'll drill it down to the micros on the other side of the break. Our list of top 10 stocks lined up next.